Great. All right. I'm going to start, David, because there is a lot of stuff to cover. And as you know, I'm going to go through it at a little bit of a faster pace. So just let me know that you can see this.
We can see it.
Okay, David. So disclaimer, thank you to the Victory Hill November update. As always, here's something that I'm going to give you a little concerns about AI overvaluation. And I'm going to give you an example of that, and a little concerns about what just happened last week, why all of a sudden everything. We now have a negative November. What does that mean? A lot of concerns around volatility. And then again, I'm going to bring up the Canada versus US because this is a concern that keeps on coming. And let's take a look at next year, a heads look at what other people are saying about 2026 there. So we're not predicting stocks here. We're not recommending any stocks here. You have your own circumstances. You see your own financial planner, your own advisor. And as always, we say, be careful of leverage. All right. We have some really great white papers. I repeat this every time. Please call up David for those. All right. Share them with your friends. To us, it's more communication, more factual data is very important out there. And then you can see different perspectives on things. It's very, very good down there. We're not trying to predict the future. We have a particular process that we use. We've been doing it for literally the beginning of the firm. We use probabilities as the past, medicine-based, which is evidence-based there, and then game theory. Okay, game theory is kind of figuring out where the future, like we've said from day one, we're evidence-based. You're not opinionating on what's happening. Here's what has happened. Take a look at that evidence. Use game theory as to similar kind of events that have happened in the past. What does that mean? And then give a probability of that. And that's kind of been our process from day one. On this one, we do use history as a guide, because it's basically human nature doesn't change. The way we react to events like last week or anything is they're literally always the same. Shock, what just happened? Confusion. And then you try to look for sources of information as to justify whatever your bias is. If you got a negative bias, you're only going to read the negative stuff. If you got a positive bias, you're only going to leave the positive stuff, right? But not kind of following the factual stuff there. We have a belief in that 70-30 rule. It's everything we do. We know that we're going to be wrong 30% of the time. Our objective is to try to reduce that being wrong. And that comes for dealing with facts. We also very much believe in simplicity. I believe personally that a lot of the investment products or investment opportunities out there are very, very complex. And they try to you go over people's heads, try to confuse them into thinking that there's something better just because they got something more complex. That doesn't tend to really work. And you see that in the investment side. We also believe ultimately simplicity leads to more profitability. All right. So as simple as we can keep things, the better things happen. This is why we kind of believe in concentration. Right. And not diversifying things, not making things too large that you can't handle them. And that a small company's potential problem can turn into a large company problem, right? Again, Warren Buffett has also agreed with us diversification may preserve wealth, but concentration actually builds wealth. Right? And what I've always kind of stressed is that if you're in the building phase of your life, then it's kind of like growth. All right? You want things to grow. You want your plants and your fruits to grow. All right. And it's about putting them in the right season, putting the care on them. And then once you're in that retirement phase, then you got to think about how do I take this growth and change it into an income stream. All right. But it all starts with growth. Every company in the world wants to grow there. So Giorgio Armani here says, and I think this is going to be very relevant to this talk, history teaches us new opportunities are born from the deepest moments of crisis. Okay, and we just get shocked into it without having a process for it. As always, media tends to cover a lot of negative news, overwhelm you with negative news. Everybody's talking about this is happening, that's happening, and then you see it everywhere. But in reality, it never turns out to be that way. So let's take the elephant in the room right now. So everybody's talking about this. Oh, AI is overvalued. We're going to have a crash. Circular financing. Companies buy AI companies raise capital, then buy chips with it, and then the chip companies buy that company with it, and they think this is kind of like some kind of a castle that's going to fall there. So the big concern is everybody still has this shock memory of 2000 when you had the technology crash, right? But the reality is, in 2000, you had stock prices move up, but earnings didn't move up. And here's the classic example of that. This is Cisco. The stock price moved up because everybody thought, hey, the earnings are going to catch up. All right. So people would be buying it and everything. And then later the earnings didn't move up. And then when they fell, the disbelief that people had came crashing. Well, this is not this case. This case, there are real money being used for this. Even if you said it's finance money, even if you said it's a bond, it's still capital going into that company. All right. And then they're helping build other companies. So earnings are moving up across the board, and we're using AI. Right. I use it literally almost every other day, almost every day, like going grocery shopping, snapping something on my AI with the picture and asking it, is there a place nearby I can get it cheaper? Just the simple act of that with your camera phone, put it into it, take Gemini if you want. All right. I'm a kind of a fan of Perplexity, but Gemini is fine, or ChatGPT is fine. Just take a picture and then type in the word, is there a place nearby me that can get this same item cheaper? And you'll be shocked how quick it happens. So again, AI is a daily kind of use thing. Now, I want to take you back to what media said about the internet. Just like they're saying about AI now. All right. So, AI, some people call it artificial intelligence. I tend to think of it's advanced or applied internet. Right. So if you think of it as advanced internet, that may be another way to look at it. So this is 1995, and Newsweek magazine comes in and says the internet's going to fail. All right. And there was a famous speech. They predicted it, everything. Well, just like what they're saying now kind of thing. And then in 2000, internet may be just a passing fad. All right. And so you get into this, why should I be investing in this one? And then in 2001, when the tech crash was happening, the magazine articles there from New York Times was saying, well, the internet's over. All right. It's done with. We had this drop in the market and nobody's going to use it again. And just as early as 2020, while we were going through COVID, they said online is not the future. Now think about this. You're in COVID, you can't go to the stores, and they're telling you that online is over, and yet you kept on getting deliveries from Amazon in the face of evidence that you're actually using it. And yet here you are, these people telling you this. So Warren Buffett says it the best, I think, and he says here, widespread fear is your friend, because it serves up these bargain prices. All right. So I'm going to prove to you that some of that's there. Okay. So we always try to go to bad news, good news, if there's a crash or recession, and the what now. So let's go to where are we now? All right. Our process is very, very methodical. We use a medical kind of thinking to this. And David, I just had a conversation yesterday with a whole bunch of medical practitioners, and they were explaining the change in medicine right now that's going on. You're going to find this interesting. The medicine that you currently have is called mass medicine. So when you go to the pharmacist and he gives you a pill, that's made for everybody who wants that pill. Yeah. Right? If it's a diabetic, if it's a Synjardy or something like that, everybody that's diabetic is going to get that. And that's because it's produced one, sell many. All right. But what's happening in medicine right now is they're going to precision medicine. And that means medicine just for you. And I'm going to give you an example of that in the financial world. Mass medicine is what we know as mutual funds and ETFs.
Yes.
Precision medicine is SMAs.
Yes.
So medicine is moving from mass to precision because technology's improved, the way of analyzing has produced, right? The detection rate has improved, and they can customize medications towards you. And AI is helping this a lot. In fact, the doctors were telling me they have their own private AI. When they have a question, they can go to the medical the only people that can use it are doctors, right? They have a code, and it will search for whatever that issue is amongst the medical journals that are currently there. It's not available to the public.
Right.
So you're seeing this change. And the reason they're doing this, because they're trying to move to precision medicine rather than broad. And I think the investment industry is going to go the same way. The value of SMAs are going to increase of the value of ETFs and mutual funds. I know they're there right now, but eventually people are going to say, how is this really customized to me? So financial planning and that I find very interesting. So again, medicine plays a big part in our thinking.
Those are tools, Rana. Those are tools that we can use to customize your portfolio. But they're just tools, but so very similar to what you're describing in medicine. They have the medicine, but that's a tool, but now they customize how it's delivered.
Applies to you, right?
Yes.
So you're still using everything out there, but it's particular to you.
Yeah.
All right. The dosage, the amount of the care that's taken over it, the constant meetings that happen, it's particularized to you. All right. So when we look at our kind of checklist of what a doctor has, we have fair and greed, railway tracks, put call ratios, and VIX. And I'm going to go through that. So our fair and greed index, by the way, we do this all the time. So you guys should be familiar with this. Whenever it gets to extreme fear, we say that is the best environment, which is where you should be adding. Then when it gets to extreme greed, we say that is the worst environment. So if you literally, it's a buy during extreme fear and sell during extreme good. So if we look at April the 8th, when everybody remembers that Liberation Day, we saw fear and greed go to 4. And it was a great buying opportunity. If we look where we are this week, last week, we saw it go to 9. All right. So if you thought 4 was good and you had this rally after 4, well, 9 is giving you that opportunity. Everybody's worried about the extreme fear, but it wasn't there. So as of, the 26th, just a couple of days ago, we've been in extreme greed now for 10 days. All right. So that means they're really trying to scare you, and people are speculating out there, and you're almost setting up this slingshot towards going to neutral and greed. Right, you need a couple of catalysts there. So if we go to April the 8th, we can see again, this is the proof that we gave on that day. We did this, is that it was abnormal. It was going down. And now if we look to now, we can see here's the April 4th at extreme greed level of 4. But what's strange is we haven't even dropped as much. This was a larger drop. This was roughly about an 18% drop. This is less. This is about a 3% drop, and yet you've got the fear of 9 there. All right, so it's kind of strange, and you can see how much fear has been pumping into it. So where do we go next? We look at something called breadth, which is the number of companies moving up to the number of companies going down. This typically gives you a little bit of headway in changes. All right. So if we notice now, what's happened is we had a whole bunch of drops there. So if you look at April, it started to drop just before April, way before April, actually. And then you can start to see it was dropping again here. So now what we've noticed is that there's a slight rise. We don't know if it's going to sustain itself. Right. But this kind of tells us that it's not a continuous drop now. So there's a pause built into it. There's another form of breadth, which is called McClellan oscillator. So what a McClellan oscillator is, a typical breadth signal is just the number of companies going up and number of companies going down. In McClellan, they overlay it with the exponential moving average of, 9 days to 39 days. 19 days to 39 days, right? That's what they do, 19 days to 39 days. And when you see that moving average change, it going positive, the 39 days and the 19 days are moving up, then it's a signal. So it's the same thing. It's advance and declines. Same thing. Just put a moving average on the numbers now. And if you notice from that, just recently, actually, as of November 26th, you've seen the McClellan oscillator go up. So if you look historically at it, 100% of the time that has happened historically since 2008, you've seen a positive. And usually by about 9 months, it's 15% and a 22%. Okay, now we're not predicting that's going to happen. We're just giving you the facts of what happened. But if you take out 2008, because of its extreme value there, you'll start to see that within 2 to 3 weeks, you begin to move into positive territory. So this is telling us something about December here. All right. And by the way, this includes periods that are midterms as well. Right. So we get a sense of what's going on by the degree of this. Now let's look at our speculation phase, which is puts versus calls. This is probably the most important thing to me because it tells me real money wise, how many people are actually speculating on it. And so when you look at April the 8th, there are a lot of people buying puts. All right. So because the market had fallen, so people wanted to buy the insurance. And when you had that up here, it's telling you, well, it's going to change because, those masses have to be wrong, right? If they were always right, then everybody would be a billionaire, right? So it's telling you that this is wrong. And lo and behold, that's what happened. April 8th was the low point. Now, if we look at recently, October 31st, you had basically from beginning October, it telling you that there's a lot of calls. That means people are assuming this is going to carry on. And in puts or calls, and you're going to see this later, they have to settle on a particular date. And the people that are backing the puts or calls or, the other side of the table is saying, we don't want to lose money, right? I call them the market makers. You may call them brokerage houses or banks or JP Morgan or Goldman Sachs or Royal Bank, whoever you want, but they don't want to lose money. So they will create an event to try and make you lose. So this is why it kind of hops in. But if you're ever in this green area, that's the comfort zone. So where are we now? After the event that we just had last week, we suddenly moved into comfort area. So our patient is telling us, right, that you went to a little bit of an extreme, but it's not as bad as you thought. Okay. Railway tracks is telling us that as well. And breadth is telling us that this slight improvement, but puts and calls are telling us speculation has been taken out on one side and the other side, which is a really good signal there. And then also we want to look at VIX. So VIX is like your blood pressure. All right. So when you get stressed, your blood pressure goes up. When you don't get stressed, your blood pressure goes down. Right. That's basically what it is. So if you look at April the 8th, the blood pressure went up. It was, like huge at 50. And we know historically VIX wants to come down. Blood pressure wants to come down, not up. If it stays up, then you're going to have a heart attack. All right. So our process in investing is to understand VIX. So when VIX goes up above the 50-day moving average, we get concerned. But when VIX goes down, especially when it goes below the 50-day moving average, we will get a little bit more comfortable. So let's take a look at where we are. October 31st, it was kind of low. It was going to go up. And then all of a sudden, it did go up. But then it came back down again. And the key thing is, it's now down below the 50-day moving average. So we went through this mini heart attack, mini blood pressure spike, and we immediately normalized it. Again, this is because of these options that are happening there. When you look at VIX and you understand where it spiked to, so this spiked to 28, right up there, 28. And you look at the history of those spikes, something interesting happens at anything at 28.7 to 33.5, which is what we experience. The 1 year following return is 15% and above. And there are many good advisors or managers that use VIX as their entry point, all right, into the system. So again, if it's 26, if it goes from 26 to 18, which it did do in 5 days. So literally, we went up and then 5 days later, it's come back down. What has history shown about that? Well, let's take a look at what is the data, not the prediction. All right. And you see historically, whenever you've gone up to 26 or plus, anything number, any 50, whatever number it is, and then within 5 days, it comes down. This becomes very interesting because 6 months later, it's been positive. All right. And so this is kind of measured. 1 day later, well, there's a little bit, 75%, but they're all skewed on your side. They're all above 50%. So it makes sense that we should be invested. And we've always said that when VIX spikes up is one of the best opportunities to be heading into the market. Comes back to the same thing I've been saying all along. It's about fear of the future and faith in the future. And we have faith in the future there. So when you learn all of this stuff and you see all this stuff, we realize that this whole year, buy the dip, has been profitable. It's not going to always be like that, but this year in particular, it has been. So now let's get to what really happened in November last week. All right. Now, this is very, very unusual because it was so sudden. So the first thing that you heard about was some from the movie The Big Short. Michael Berry comes in and starts accusing AI hyperscalers of artificially boosting earnings. Now, there was a reason for him to do this. He had been losing money for a lot of months. And options expiry is coming up. And he's holding a lot of shorts. So the only thing he could do was put out the news that this is going to be terrible. The media grabs it, puts the stocks down so that he wasn't at a loss. Eventually, he did close his positions down because he wanted to go more private than public. So you took companies that were doing good revenues, hit them with the scare of people, and this is kind of led to this kind of drop in it. And then you had interest rate fears as well. Are they going to drop interest rates or not? So a lot of this blame actually goes down to short sellers. Short sellers, this is from Financial Post telling us here. So I always try to give proof with everything. It's not an opinion. This is what has been said. Short sellers, they're blaming the retail investors for the worst returns they've had since 2020. And the only way they can make money back is if they make you lose. So this is why there's this huge amount of jumping onto the negative news. All right. So realize you're in a battle. All right. And, they want to protect themselves. So what you saw this dramatic drop. It was positive all day. And then just around, somewhere around 10:30, it's always 10:30. There's a reason for that. And then all of a sudden you see this vast drop in the market. All right. And here's the headline. All right. So S&P drops on tech wreck. Did you see how they use the word tech and wreck? Why did they use it? Because it reminds you of 2000. And I'm looking at this going, seriously, this is what you call a wreck? You're literally only like 3% away from an all-time high. And you want to call this a wreck? So again, this is how they manipulate you, right? It's focus shifts to NVIDIA results. So you had a 2.97% drop. All right. And you saw a dramatic drop, right? 10:30 a.m. 10:30 is very important. All right. It begins to drop and, unemployment situation coming. Say we don't have the data because of the lockdown, shutdown, which is kind of garbage, really. That data didn't matter. All right. And then at 12:20, you had a big drop in the market. So they say that the market lost 1.5 trillion in value. It didn't lose anything. It's only lost if you sold. So If you sold one share, it would have dropped for that one share. And since it only measures price, not volume, you can't really say it lost 1.5 trillion. All right. It's just the next price in it. So you carried on seeing it at 130, it tried to go up. This is the same day. And then, you see it trying to resort back to sell by 3. So this is just one day on the 20th. And then you saw this extreme greed on that day go to 9 because they believed it. You see a sudden drop and it's not you that's selling, but you take that on, oh, my value's gone down because it's based off this price. Hey, and what we noticed was that call volume just before this. So this is the 19th, right? So remember, options expiry date is the 21st. This is 20th. This is the day before. You had the highest amount of call to put volume. That means calls were very, very high. So think about it. If a call is high, that means somebody's saying that this is going to be positive. On the other side is a brokerage house that says, oh my God, I'm going to have to pay these people. I don't have the money because I have to go out and buy it with the money I got in my pocket because they said it's going to be, let's say, $10 price. I don't have that. I haven't been doing a lot of option hedging or delta hedging, they call it. So I will physically have to take cash out of my pocket, which I don't have, and buy the stock to give to David Smith. Because David Smith made it right. But they don't want to pay you because they don't have the money. So what do, David? They say, it's not going to hit $10. We're going to give you some value so it hits $9, $8, so that we don't have to pay you. Yep. That's exactly what happened. You can see it by the amount of call options. Right? And you can see it, the put volumes all of a sudden. After that, the put volumes, this on the 20th, volume started to hit. And then you saw this spike up in VIX. And I said on that day, November 20th, I wrote, needs to come down. Right? So here's our proof on it. And if you look at it, like we've said before, if you hit that value and it starts to come down, then a year later, it's about 13%, 77%. So you got all this panic. VIX here was 4, here it's 9, and yet it didn't cross the moving average. It didn't cross the 128, which was a very good sign for us. So it's saying that this is not real. It's not like what we saw in April when it did cross below it. So evidence-based, right? Keeping the evidence. So what happened after that? Well, November 21st comes along, and we're going to go into November 21st in detail. But all of a sudden at 10:30 on November 21st, remember I told you 10:30 is important, everything begins to change. So here is 3 days before that, 1 day before that, really, and then here is it onwards. So this is a manufactured event because options expiry was on there, right? So OPEX. This has nothing to do with NVIDIA earnings, nothing to do with interest rates, nothing to do with Putin, nothing to do with Trump. And nobody covered this in the media. No. Right? And so if you look at it, the option dates are programmed. Everybody knows what they are. November 21st. This is the option calendar. It's free. You can Google it. You'll see when the next one is. Right? So here's what happens with options. On November 21st, there was $3.1 trillion of risk. So if all the calls had come in, that would have been the banks have to come up with, watch this, $1.5 trillion. They don't have $1.5 trillion of notional value. That's the amount that's out there. All right. So this is a big panic. This is why they had to bring it down. And all of this. So when we look at it, this is not an OPEX week, the time before. And then all of a sudden you fall into the week of OPEX. Like, look at the difference that 1 week made. All of a sudden you see, and yet not too many investment managers understand this. Big firms, they don't even grab this one. How important this is here. So when you look at it, this was all about 3.1 trillion. Here it is on November 20th, right? Look at November 20th there, and then look at 21st there. So when you see this happening, if you look historically, after that OPEX event happens, fund flows start to increase because you've recorrected that put to call. It's gone back to zero. So then you can redo it again because December's coming up. But let's look at timing. So all this settlement of 1.5 trillion happens just around 10:30. Here is 10:30. And if you look at that particular day, after 10:30, it begins to move up. Why? Because these have been settled and the calls haven't been exercised. That means the banks can now start from zero again. They save themselves and they can start to buy back, right? And do things. So this whole thing about 10:30 is very, very important. And so now what you have is after that shocking drop, which everybody said, where did it come from? We're back up to it again. It's like it never happened. So now let's understand options expiry. This is a very cool one. All right. So options expiry isn't always negative, but if you look at something that happens before, then you'll get to see an understanding. So each one of these are options expiry dates. When you see it go up just before options expiry happens, then it kind of begins to go lower. All right. Just around there. If it goes up, then it can go, this is this year there. But again, this is going up. Then you saw options expiry date may go lower. Then again, it picks up again to normal, right? And oops. And then what happened right now is that, I'm clicking too far. All right. So here. So when you look at the options expiry in the summer, remember, summer is most of the traders are on vacation. It's a vacation period. So those options expiries, option dates tend to be good. Now you've come back from summer. All right. So, you're into the September options expiry, a little bit bad. So there's more and more people getting confident that my calls are working. I'm making so much money. So they take more calls on, and taking more of that calls on puts a bigger risk for banks. So what happened this time? Last one in October, it was going lower. They pushed it back up. More calls were going in. And then they said, let's slam everybody. And they did a big drop of options expiry, lower than this options expiry date, lower than this options expiry date. Do you see what they just did? They wiped out everybody. So
Rana, I think this is very, very important because we talk about this a lot. And earlier in the year, I think September and October can tend to be not good months. And if we were going to see a nasty OPEX, likely it would happen then. But we had good months in September and October. And November, historically, you don't see this type of pullback. But your chart shows the market has gone pretty much straight up for too long. And as you said, then it became out of control with the record
number
volume.
Of calls.
The volume of calls.
It's the volume of calls that indicates to you that the counterparty, the banks, has to protect themselves. They're in it for themselves.
Yes.
Right. They're not here to do, they're not, here to look after you. They're here to look after themselves. So when they see their risk go higher, they'll pull it in. This is why when you see mortgage rates drop, banks don't really drop them that much.
Yeah.
They're supposed to do a little bit, but they kind of argue about it. So, they're just so self-centered, and that's fine if you're invested in them. But this was going to be a major risk because 3.1 trillion of notional value is extremely high.
Yeah.
If this had gone the wrong way, you would have had some major banking disasters coming in. And remember, there's already a disaster going on in the banking world. We'll talk about that a little bit later.
Yeah.
So now, if you look at that 50-day moving average, after 100 days, okay, you'll see that when it closes below its 15-day for the first time in 6 months, you'll see later, about a month later, it's 100% kind of positive. So, it closed that on November 20th. So December the 20th, most likely, according to history, is going to be positive on this one. Again, the 50-day. So you did drop below the 50-day and then you came back up. This is not like April. Okay. So we've had many drops along the way. So investors panicked on this one, and then they tried to get back in. So they saw it, they panicked on Friday, and then now they're saying, oh, I want to get back in. Well, you've had that before. All right. And if you look at the history of people panicking around OPEXs and then trying to get back in, 12 months later, it's actually got a 100% track record on it, the 10 times that you've had that. So back to the same scenario. This year has been about buy the dips. All right. Don't be afraid of it. It's not going to be that every year, but it is. And Michael Burry, by the way, he has a terrible track record. Not even close to being good. He had one good call, and he's been running off that because they made a movie about him. All right. But his sell markets went up 49% after that. All right. Could be worse than 2008. It went up 67%. Greatest speculative bubble in 2021. The markets went up 47%. Significant bear market. So 134%. So you can see he's continuously been losing money, losing clients. So he needed to pull something out. We have a process, and we call this our broken arm syndrome. We've explained it. Whenever the market drops by a certain amount, we set in and buy positions or calls. All right. And this is what we've kind of said, this is a long call. You buy it at a position, and as it goes up, you get higher, and then you can sell it to buy the actual stock. All right. So there's a process in doing it. This is literally every market drop. Never going to get it right. So you keep on doing it slowly on dollar cost average into these things there. So now let's talk about the bad news. Now that you know what happened, all right, and I can tell you it was totally not what you were told. Every single media outfit, I monitored it. Not one of them talked about this one. And I understand why, because then you're calling out the risk that was in the banking system. So first of all, AI is going to be a significant impact on labor. Okay. So MIT is saying that AI will replace as much as 11% of U.S. workforce. All right. So this is going to impact people. People are going to start to retire, and the risk is there, and they're going to retire before they even know it. AI is advancing very, very quick. And you can see HP just laid off 6,000 people. All right. That was on Tuesday. And even in Canada, you can see here that McKinsey cut 200 jobs, and they're shifting the roles to AI. So AI is taking a lot of McKinsey work. So layoff notices are happening. And you can see on the real estate side, I know we have a lot of friends in real estate, and you can see that even Barry Steinlich says he's, letting go of employees because AI can do the search for my properties. AI can do the search on what are the advantages in each property, like has it had a flood in the last 3 years? When was the last roof done? All right, what are the comparisons of this? So real estate agents have to seriously think about their job future. All right, because it's going to start changing on this one, and you're going to see a lot of tech companies that are in the real estate space that are currently there, right? And they're going to start increasing it and do it, and these guys are going to do it for less than tiny amounts of commission. They don't need a lot because there's not a human being attached to it. Okay, and they'll book the meetings coming in, they'll book the shows, right? They'll book all the people for them. Because you can already do that with AI. So the bottom line is that there's a report that was just put out that manufacturing jobs will be automated. 57% of work hours in the U.S. are going to be reduced. Assembly plants are going to change. So this becomes very concerning for people that are currently working and living on their livelihoods of, I need this check coming in. So our whole objective is for people to talk to a financial planner, look to our financial planners, the ones that we have, and to start thinking about this program before it happens. And we're ahead of the curve on AI layoffs planning. Okay, so I would strongly recommend getting a hold of David, talking to him, and lining up the planning process as to how it is. A general run-of-the-mill financial planner won't grab this because they just focus on CPP, OAS, and what do you do with your RRSP and RIFs, and they're not thinking about you got laid off tomorrow. What happens? Okay, how do you tackle it? So this becomes concerning. Canada actually has it worse. The unemployment rate by age group. So right across here, 15 years and older, it's 6%. But 15 to 24, these are the people coming out of university, 14%. All right. And these little dips, they don't even matter anymore. And then you got the 25 to 50 years olds. The least unemployed is actually the 55 years oldest, but there's a reason for that. Once you leave work and you become a pensioner, you don't actually get in this equation anymore. So this is actually a lot higher than what they're saying. But unemployment is higher, and finding jobs afterwards is going to be a lot harder. So when you look at this, the young generation is the greatest at risk of AI. That's the greatest, because what they taught you at school, at university, isn't about AI. All right. And so you're seeing layoffs happening all across the world, college educated students. In the US, the job loss is at 25%. So 1 in 4 who is currently working in white collar with a 4-year degree is getting laid off. Okay? Again, the reason I'm saying this is you got to start planning while you're in the job there, right? So college graduates, again, it's getting up high there. And this is leading to a serious problem in real estate. Because once you get laid off and, you're not getting income from that work or something, and you can't get a job somewhere else, well, it starts to affect home prices. So you can see the house prices are sounding less. There's less buyers. Even the millennials and the Gen Zs are not coming in and buying. They're preferring to rent there as well. But you're not seeing the sales there. And you can see the condo market as well, in Toronto especially. And everybody's wondering, when's it going to come back? I don't have an answer for that. I think everybody has an opinion on this one. And I don't think the answer is going to be lower interest rates. The answer is actually going to be more jobs plus lower interest rates. It's no use dropping interest rates, but there's no jobs to protect you from even paying that lower interest rate. Both husband and wife are out. What does a lower interest rate mean? All right. So this becomes concerning on this one, especially in Canada. But the biggest scare that I have is the decrease in population in China. And this is going to come. We've talked about this before. The more your population increases, the more consumption increases. The fact that it's lower, it isn't. But here's what's going on that most people haven't realized. And this is from Thorsten Slock at Apollo. And he said in 1963, you had 33 million babies born. In 2024, there are only 9 million. So 1963 to now is roughly around 62 years old. That means you have 33 million people, roughly, some have died, that need to be serviced and they're not working. And now you have 9 million. So going into the future, 10, 20 years, you're only going to have 9 million of workers. So this puts a huge burden onto China. China can't support this. So what China has been doing is something very interesting. Since 2014, China has been selling its U.S. treasuries, the yellow line, because they have to finance their population, which is declining. So the amount of cash that they have in their bank accounts, which is U.S. treasury, has declined. All right. And that's why they kind of needed to shift to gold, because they need to have some protection for their currency. All right. So what you see now is the debt load in China is surpassing in percentage terms the debt load in the US and Europe because of this population decrease. So this is only going to get worse, because you can't just magically have another 33 million babies pop up. Sure, it's going to take at least 9 months to do that, and they all have to get active in it. So it's not going to happen. This is a continuous cost to it. And so you're starting to see. And the impact of this falls onto the crypto market. Because China is a big part of the crypto market. So all of a sudden, you've seen big crypto ETFs outflows. Remember, there was all these crypto ETFs, BTIC, and everybody was getting excited. Oh, you know what? I can buy my crypto as an ETF. All right. Well, now you're seeing the reverse of that. You've seen sudden shock. BlackRock saw a massive outflows out of their ETFs there. Okay. And Michael Saylor, who uses debt to finance purchasing ETFs, well, he has a severe problem because now the value of his stock is below what the purchase of his ETFs are, which he's done on debt. So if it goes any lower, he creates a big problem. I hope it doesn't, but I want to see this experiment run through. But if Bitcoin keeps on dropping, because he has to service debt and he has no form of servicing debt. The only way Bitcoin doesn't pay you interest. So the only way he can service debt is to sell Bitcoin. When you sell Bitcoin, it pushes Bitcoin prices lower. It's kind of lower, and that hurts him more. So it becomes a vicious cycle. He has to sell to pay off debt, even if it's a little amount, which causes it to go lower, which increases his debt load. So this is terrible. And you saw Bitcoin drop. I really hope it kind of stables. Michael Saylor now, his net asset value is negative. Okay, so everybody that was pumped up about strategy, MicroStrategy, this guy's, the next, he's the next messiah of investing. He's not Jensen Huang. He's not creating a product. All right. He's basically using financial accounting, all right, corporate financing to buy a product out there, but with more debt. Jensen Huang actually made a chip or designs a chip that people are using day in, day out. That's not the same here. Okay. Google is a search engine that's not the same here. Apple pays a dividend. That's not the same here. So you can understand what the risk is happening now. And I really hope it doesn't happen. But there's other problems. BlackRock had 100% loss. This is crazy. BlackRock lost 100% of their money on a private loan. So here's BlackRock with all these genius analysts, these fantastic guys that know mathematics, know finance, went in and approved these loans, and then they go belly up. Well, how many people are keeping these guys accountable? And this is only the one that we know. Usually, if it's a cockroach theory, if you have one, there's others behind it. So again, right now, they can take money out of somewhere else to bail this out. But at some point, if there's too much, they can't do that. Okay, so we're saying this is a risk. And you're seeing it happen in commercial real estate as well. Commercial real estate hasn't picked up. So let's respect the bad news. And some of it's going to be terrible bad news. All right, if it continues this way. People should be caring about crypto. There's many forms of crypto, but take a look at the problems that can happen. We're not saying it's going to happen, but if it carries on, then it becomes disastrous. So now let's take a look at negative Novembers, because we were told historically November's pretty good. All right, especially after a run like we had. And all of a sudden, in the last week, the week before the last week, options expiry week, like I explained to you, the market makers, the bankers decided to crap on November. If they hadn't done that, our November would have been positive. So, but let's take the evidence that it is. So when you look at November's, all right, we had 1, 2, 3, 4, 5 months positive. We actually had February, March, and April negative. And then we had positive. So what happened is in this period, all the calls went up. Like I explained, you just had 5 months of positive, so people keep on buying calls. And that needed to be cleared out. That's November now. So when we look at the history of negative Novembers, all right, so 2025 is minus 3%. 2021 was minus 1%. So let's take a look at that happened. 99 minus 4. You can see, look, there's a couple of zeros there. But the worst one was 1943, minus 7. So it's not a disaster if November is negative. It's not going to, break the bank. But what happens afterwards? Here's what happened afterwards. Right now, I can't predict that this is going to happen again. All right. But knowing that options have been cleaned out, knowing that they've cleaned the books and they need to rejig the game again to get people to buy calls and everything, okay, or puts, one way or the other, they're going to do this. So if I was a market maker, I would let people win till somewhere around February or March next year. That gives you 1, 2, 3, 4 months, just like they did before. And then I would, do it again, if I was them, though. Okay, so the key thing here is a negative November of a slight negative usually leads to a pretty good December. And if you notice here, most of them, they're a lot bigger than what the November drop is. -1 gives you +4, -4 give you +11. Here it was a little bit +1, -1 gave you +5, basically 0, -1 gave you 2, 0 gave you 4, 0 gave you 5, -7 gave you +6, -3 to -3. So usually the December makes up for it. And if you look at the history of January to October is positive, and then you have at least 10% in history, and then November turns negative. So here they are, all of them. So these are all the January to Octobers of greater than 10% return, which is what we had. And then you get a negative November, even a slight negative to it. So here's the negative Novembers there. 2025, like I said, is lined by 2. What happens in December? Well, every single December has been positive. But that doesn't mean that from beginning to the end of December it's going to be positive. You can have a little drop in a December, but by the end of December it's positive. So here's the December max loss drawdown. All right. But the December to the end of the year, the drawdowns can be there. Okay. So that's normal there. So when we try to look again at the same thing, when you have a negative November, this is S&P 500, the December has been positive, December has been positive, December has been positive. This is only since 2010. Okay. Again, same thing. I'm just going to give you different data sources to say the same thing. So you realize it's not us saying it. We're not opinionating here. All right. November was negative. December was positive. November negative. December positive. November negative. December positive. But the last 2 months of the year were positive except for 1985 and 1986. Okay. And that was because of the oil embargo that was going on there. So FactSet says the same thing as what we're saying. Now let's get to Thanksgiving. What happens around Thanksgiving? I'm going to cut it out simply. In a post-election year, you have a negative November, all right, 2021, and then December was positive. And the following year was positive as well. So this is kind of good, right? Again, there's a lot. The 25% of the largest companies, why we like concentration, are up year to date as of the 21st, 22%, whereas small caps have suffered a lot. Okay. So why is this happening? Because the revenues on the large caps are stronger. In fact, we've had a large revenue and earnings increase, the strongest earnings growth since 2021. Okay. This is what's driving, and it's predicted to go even stronger, and earnings derive something. So when you look at 2026, you see earnings go up, have a pause, and then they go back up again towards the end of the year. And we've always said earnings eventually drive the stock markets because that's what you're buying. We've also seen, because of the drop in the markets last week, you're seeing an increase starting to happen in buybacks. They announced it earlier in the year, October 31st, but that doesn't mean they triggered it. So I would suspect that there's probably been a lot of buybacks going on in the last week, which is why you had such a swift recovery. Okay, so this is going on. Now, here's things to consider here. All right. Volatility happens every single year. Like, this is every single year since 1950. And yet not every year ends negative. So if we look at the period, you can see a lot of greens despite the volatility. Right? But every single year is going to. This year we've had 18.9, and as of that date, they were up about 13.65. This is the 21st there after the OPEX there, and so there is definitely more green towards it. Now, let's go even deeper into volatility, because I tell you, volatility is your friend. So this is the year 2023. In the year 2023, in the first half, most people have forgotten it, the markets dropped 8%. Then the second part of the year, the market dropped 10%. But for that whole year, the market was up 26%. Right? So you need to zoom out. In 2024, the market dropped, roughly about 7% there. And then in the second half, so first half, second half, the second half was a little bit bigger in both these times. The market dropped more than 8%. The market was up 25%. This year, we had a massive drop. This one doesn't even count. And yet the market, as of this day, this was as of November the 7th, was up 14%. So don't be shocked by volatility. Have a process like we have on how to take advantage of every volatility. So we actually get excited about volatility. It allows to put out processes. So if you look at the history of the markets here, you're going to notice something interesting here. This is a very, very interesting chart, which tells you how long prices drop for, markets drop for. So in 2000, the stock market was negative for roughly about, if I look here, 8 years. 2001, if you bought in 2001, so this is when you bought in. If you bought in 2001, you would still be negative for 4 years. But after that, you shot up. In 2008, you were negative for 4 years. So if you look at history, the worst kind of incident we've ever had is 2000, where, you can say but it's roughly about 10 years of negatives. Hey, those 2 years were okay, but then. So since 2009, the whole industry has changed. Our drops in the markets have only lasted 1 year. So if you have a drop in the market, this may be one of the most opportune things that you can have. Accept the drop, right? Accept that it's happened and you figure out how, because they've never lasted more than 1 year so far since that. So how do you now take advantage of a market? Well, there's this study that was done, and it said the more concentrated a market is, that means that the more the top companies are driving the market, either like Mag 7 or something like that. It's not something to be feared. That's when the market goes higher. When you get falling concentration that is more broad, the market goes up, but not as much, 10.9%. Again, more concentration, 23%, less concentration, more broad recovery, 3.6. So you actually want a market that is led by the top 7, top 10, top 20. And that's how you should invest in concentration, okay, which is what our processes do. And so I'm going to skip over this. So NASDAQ 100, 7 months in a row up. What does it mean? We saw that. We're also now stepping into what we call the best period, which is November to April. Okay, now remember, we're stepping into midterm year, so we got to be careful about that. Again, it's the strongest period, higher about 76% of the time, so 24% of the time it probably won't. I want to repeat what I said last time about Canada versus the US, because a lot of people are saying my Canadian equities have done better. And I'm saying, sorry, that's a rare event. It doesn't happen too often. All right. Here's the difference between Canada and the US. Canada's higher technology. US has higher technology. Canada has very low technology. Canada has higher financial services. All right. US has higher consumer discretionary. US has higher communication services. Canada almost doesn't have that. Canada has higher industrials than the US. Canada has way higher energy. So if you're looking at this year, why did Canada do better? It's very simple. It's the financial services, because they're talking about interest rates going down, and higher energy, right? Which is because of data centers and everything. So when you look at the history of it, whenever Canada does better, the years after that, the US does better. Whenever Canada does better, the years after that, the US did better. So this year, Canada has outperformed the US. Well, probability says I should reallocate out of Canada into the US, because it tends to be that the US does better. Okay, now we can't guarantee that, but since 2015, there hasn't been a 2-year run on Canadian securities. And this is kind of what we kind of look at. So again, here's something that's very interesting, and I think it's going to be a good thing going up. Oil prices have fallen, and oil prices have fallen to a low. And a lot of that has to do with the Trump policy of drill, baby, drill, and convincing supply to increase. So Trump is bringing inflation down by pushing this out. Okay, so crude has gone down. Oil adjusted by money supply is low as well. So there now it gets to be a bit of a concern, because you can't have oil too low, otherwise those companies aren't making money. So then supply begins to shut off. So oil actually becomes an interesting contrarian play now, right? Especially next year being a midterm year. So if you can spike oil up, right, based on whatever event happens around the world, this becomes your value play, right? We're not predicting, we're just saying this is kind of like game theory on it. And then you can now get those Canadian or energy companies with good dividend yields, and then be able to advance that from there. And, because the upside is on your side because of how low it's been. So when you hit this adjusted for money supply, this is oil price divided by M2. Okay, so whenever it's hit this zero line here, oil prices have tended to go higher. So this is why it starts to become interesting as an opportunity here. Crash recession, GDP is at 4%. Okay, you do not have a recession when GDP is going at 4%. Interest rates, they're still a lot higher. They should be a lot lower. Canada is being very stubborn. There's a reason for it. Canada is running into even more problems, like I explained, with layoffs. And the government needs more money to pay for people and the unemployment benefits and things like that. So they need to borrow more money. And, this is going to become a problem. Canada rates should be dropping, but not as fast as they're predicting on it. There is no central bank hiking rates now. This is very different from 2022 when everybody was hiking rates. So we're not in that same sphere now. So this is a good sign for it. CAD, so whenever you have Fed cuts near all-time high, it's better. Now let's get on to the interesting news, which is about our companies. All right. So when you look at the companies here, we've always said, know what you own and why you own it. Our process is built on companies that increase productivity, have innovation, but more importantly, there is a demand for their product. If you have productivity innovation, but you have no demand for your product, nobody's going to buy it. Let's talk about the Edsel car, right, or anything else like that. There's no demand for it. And then we want to look for stock buybacks, because that means that the company is growing so much that they can use some of their cash to buy back their stock to pump up earnings even more. Okay. We also are big believers in innovation. We believe we're in the sixth wave. At the beginning of it, like I said, AI isn't just artificial intelligence. It's actually advanced internet. Think of it that way. Okay. So what you've noticed is those companies that are tech companies, all right, have a higher profit margin than those companies that are not tech. And this is why, since basically 2000, just after 2001, or especially 2008, tech companies have been doing gangbusters just because of profit margins. Profit margins comes because you have more revenue and more earnings. So it's kind of simple scenario. How much profit margins do they get? For AI companies, their profit margins are around about 25.2%. Any company that doesn't have AI, the average, their profit margins are 11%. So why would you not take that? Okay. We've said that now we live in a world where technology is mandatory. Everybody has technology. Like I told you, I just went grocery shopping, took a picture of it, went on to whichever one I used, and I said, is there a cheaper price for me? And actually, it stunned me. It was a lot cheaper. And I'm just buying biscuits. right? I just did it for the hell of it, right? Just buy biscuits. So, do that and then go and pick from wherever you are. It wasn't even a far drive. It was literally, a 5-minute walk to the next store that I had got the other thing, but it saved on it. So now let's talk about monopolies when it comes to it. So when you think about a monopoly, that means there's only somebody that dominates that and everybody else is secondary. So in search, Google is a monopoly. No matter what you think, you can use other ones, but you're still going to be mostly using Google. In fabrication of chips, the monopoly is TSMC. It's not Intel. It's TSMC. They dominated around the world. When you look at lithography, which is putting the equipment to make that, which is manufacturing the equipment that TSMC needs. So this company makes the equipment for this company. And then this company, Google, uses this company to help it make chips. So they're all connected. But guess what? They're all monopolies. Now let's talk about duopolies. That is, there's two companies that dominate an industry. Well, for GPUs, general processing units, it's AMD and NVIDIA. Nobody else really. With CPUs, it's AMD and Intel, not NVIDIA. Now, for ASICs, which are specialized GPUs, okay, so think about medicine here. CPUs are like mass medicine. ASIX is like precision medicine. Okay, that's Broadcom and Marvell. So these are the only two choices you have. You can buy both of them or whatever. Now, when it comes to credit cards, sorry, but it's only these two. You may have your Diners Club, you may have your American Express, that's it. But how about credit ratings? There's only two. How about operating systems? You're either Apple OS or you're Android. So it's Google. How about energy, gas turbines? So gas turbines are used right across the world to change, natural gas into electricity. And that's what they're essentially doing. And they change hydro as well into it, everything, but it's basically turbines. There's only two companies in the world. One's German, Siemens Energy, and the other one's US, GE Vernova. There's no real other choices. When it comes to social media, it's Meta with Facebook, Instagram, okay, and the other one is Snap. So think about what you're doing. And if you notice something here, very interesting, most of these companies are American. Only Siemens is not American. But Visa, Mastercard, American, Broadcom, Marl, American. So this is why you can't dismiss American. So the AI, the companies that are driving AI are basically Alphabet, NVIDIA, Broadcom, Microsoft, and then there's the rest. And these Magnificent Seven, how have they done year to date? Well, Broadcom's actually the highest returning. This is as of November 19, 61%. Then it's Google. And we're going to talk about Google. Then it's NVIDIA at 40%. None of these are really, if NVIDIA dropped 50%, guess what? 20% is still a great number for a year. If Broadcom loses 50%, 30.5 is still good. Okay, so all this spread doesn't matter. But let's look at cash. Who has the most cash? Microsoft has the most cash, but take a look at Google. Right? 98. I'm going to keep on going. And then take a look at Amazon. So if you have cash, if your stock price drops, you have the cash ability to buy that stock. If you don't have cash, you can't buy it. And then you can keep a floor to it. Alphabet is a very, very interesting story. Okay, so they came out with Android, things changed. Then they bought YouTube. Like, think of it from a search engine. You go to Android, then you go to YouTube, then you created Chrome. All right. And then they did Alphabet. They restructured the company under one. Then they did something interesting. They bought a company, HTC and another company, and they created Pixel phones, Pixel watches, right? Which is kind of what I use. I use a Pixel phone and a Pixel watch. Okay. And then after that, they, started doing Fitbit to take the fitness into your watches. So this has been a company that has been, you could have bought it at any one of these purchases and you would have said it's too high. Okay. And guess what? Recently, some guy just realized he had missed the boat. And so he decided to put $4.3 billion into Google after all the years of talking against it. Now, it's a small part. It's 1.3% of his portfolio, but they started. Okay, so this is a big message. Google leads on cloud, right? Google cloud growth is 108%. Google's revenue has been going up. Google will have negative. Every year its stock price drops, right? So if you look at the stock of Google, in 2025, it dropped 29%. But right now, it's up about 67. In 2024, it dropped minus 22, minus 17. Okay, so you've got to expect that your stock is going to drop and have a process for that drop. You just buy it, not be certain, but have a process for it. Because they've just launched Gemini 3, and it's kind of very cool at what it does. But Google is the only company which has a complete vertical on AI. All right. So they have accelerator hardware. ChatGPT doesn't have that. Foundation models, they have that. So they are the only company that has everything to do with AI. But what happened is the stock dropped this year to around about 150. Nobody bought it. As soon as it goes up to 300, everybody crowds into it. So think about this stock. 10,000 then would be about 1,000 now. That's 2004. But you would have had to gone through some very, very nasty drops. All right, very nasty. In fact, this year you had those 29% drop that I showed you right there. Actually, the drop was right here in April. It dropped 29%, and people were complaining about it, and yet it's up there now. And so don't understand the business, know your business, see who's using it, and then start to move up there. And you couldn't have guessed it. Over there, you would no way have guessed that it's going to do that. But you knew the business. So what has translated now? Larry Page has become the second richest person in the world after Musk, and Sergey Brin is now the third richest. Right? All because they did Google. And people make a mistake on Amazon. Amazon, if you look here, it's going to spend $50 billion on infrastructure for them. But Amazon is all these companies, broadcast, everything. Amazon is the mutual fund of AI companies. Everybody thinks of Amazon as just retail, but they've literally got everything there in different countries. So they're a mutual fund for AI. And here's the beauty of what just happened that nobody paid attention to. The government just launched November 24th, the Genesis mission. This is a huge thing. This is the government is putting all of its power and helping companies to create an AI initiative to merge science data across the world, across the universities, across all the companies to share their knowledge together and create an AI. This is something not even China has. No, Europe has this. Every university is now going to combine together and share their leapfrogging university. And this was under Trump. All right. So it's going to create a huge difference. You're going to, increase. This is the Genesis initiative. All right. This is a blueprint. It's going to, the science and security platforms are going to increase. It's going to start to get involved in day-to-day things, data sets and, energy side as well is going to be part of it. So you're going to see a large increase in GPUs, ASICs, FPGs, field programming, and edge AI. And who are the companies behind these? Well, NVIDIA we know is GPUs. Broadcom is ASICs, but so is Google. All right. And then you got field programming, which is, again, AMD. All right. And Intel. And then you got edge AI, which is primarily going to be Apple. All right. There and NVIDIA. So you can see anybody that's saying the overvaluation of NVIDIA hasn't understood what the Genesis Initiative is. And this is why Jensen Huang is so close and friendly with Trump, because they're going to be using all their research to help a whole bunch of other companies so that the valuation and the earnings of NVIDIA and companies that are involved in the initiative goes up. So overvaluation, it's not there because you're not looking at the change that Genesis is going to have on it. Okay, and you can see it in other countries. So what's happened is Trump has now said, well, you know what? Maybe you can sell your chips to China now. China may not take it on. That's fine. But that can happen. And so NVIDIA came in with great numbers. So when the stock market fell and they said, oh, NVIDIA is overvalued, it made no sense. Right? And then you get people like Peter Thiel who says, I'm going to sell my entire NVIDIA stake. Well, he can. And here's what not being told to you. When he says to you, I've sold something, he hasn't told you what he's buying, has he? All right. So I expect him to be buying a lot more into the Genesis Initiative. Companies that he may end up doing Broadcoms and things like that, going to ASIC models. So even though it's a negative title, I actually don't think it's negative at all there. NVIDIA blew the charts out. Look at the net income net profit is 56%. They had a gross profit of 73%. That's a wow. Okay. You can see the increase coming in data centers. There's a power lag. You need more data centers, not less. There's a backlog of U.S. power. And so, on our side, we're working very heavily with a private equity side on data and power for the internet. And it's exclusive to us. All right. So we're dealing on that. It's private equity, which is part of the reason I was in the Middle East, in Doha, Qatar, convincing them to look at our solutions to power, because they're going to have data centers there and AI is going to be big in the Middle East. Well, they would need our solution. So we're kind of doing that. US is in the lead of creating data centers there. You're going to see an even bigger demand come up from there, doubling by 2030. And it's going to be huge out there, 173 gigawatts, when currently it's only around 4 gigawatts. All right, or 33 gigawatts. This is a big demand for electricity. And then you can see that here's what most people have missed out. U.S. just signed an $80 billion pact for nuclear reactors in AI. The U.S. hasn't done a nuclear reactor. All right, so the 3 Mile Island, but you're going to start to see them do more in nuclear power, which because of the demand of AI. AI is a 5 trillion data center boom. All right. And so to do that, they're going to have to take on more debt. So the US debt is going to increase. NVIDIA ordered so even during all this negative news, what nobody told you is NVIDIA just increased their orders by 50% to get more Blackwell, wafers for Blackwell. So guess what just happened? Google is beating up NVIDIA. All right. And TSMC wins no matter who wins. NVIDIA uses TSMC. Google uses TSMC. So it's not hurting TSMC. So now let's get on to what now, right? What has been the environment now? So December tends to be positive. We see that S&P 500, it doesn't mean that it can't be negative because number of downs is there. It's 73% of the time positive there. Post-election year, which is this year, tends to have a little bit more ups than downs. Okay, now, if we listen to OneStrat, what they said is the reason that the markets will go higher is government shutdown has ended, Fed cutting is starting to have a seasonal strength, equity market was oversold, you're going to get that come back, which makes total sense, and investment sentiment is bearish. So this is their lining for it. But I listen to the people that can actually make a decision, and that is Scott Bessent. This guy is the most brilliant financial person probably on earth, right? He's the one that bankrupted the Bank of England and told George Soros how to do it. Scott Bessent. I am very optimistic in 2026. We have set the table. He's telling you something here. I set the table for a very strong non-inflationary growth economy. And he has the power to do it. Okay, so strategically, you will start to see U.S. government buying into companies next year, you will see the U.S. government lowering interest rates very strategically whenever the Democrats want to bring the market down to their beach. So buy the dip might just be another plan for next year. Okay. So what does the brokers say for 2026? RBC 7,100 and Deutsche Bank says 8,000. So it's a big range there. But UBS comes in at 7,500, right in the middle there. So there's a lot of positive side to it. Goldman Sachs saying the same thing. This is just the same thing. When you look at December here in the spread of all the volatility, they actually don't have a big spread. It's very tight around the middle. So that means that in history, this is every year, okay, this is since 1930, every single year, the month of December has very little volatility between highs and lows. All right. Back there was one there. Unlike November, which did have a very high low there, right? Maybe one they had there. And the most volatile is actually March. So remember this next year, when March comes along, March has a high volatility on ups and downs. Okay. So why do we feel confident now? A little bit because options has gone behind us, but also because, David, you're probably going to get a nice gift this year. Okay.
Santa Claus is coming?
It looks like Santa Claus is coming because, the Grinch has been killed last week.
Yeah.
All right. So, FactSet agrees with us on this one. Historically, it's also agreed. Ed Giardini does. When you look at Novembers and Decembers, November to December changes positive there. November to December in 1980, when you had a down, the same drawdown as before. Okay, up. We're kind of confident of this area. Okay, so again, fall is kind of good there. The month that has had the 10% drops, the least amount of drops is, like a 3% drop or 5% drop is actually December 4. So that gives us good hopes there. Gain on this. So now let's talk about midterms. All right, midterms are going to come along. It's typically a little bit in midterms. We'll likely see some volatility earlier and later in the year. When you look at the history of midterms, though, this is 2026 here. When you have a president in the second year, which is the blue line there, you still have positive. A new president is more negative. And you see, it's really the post-election, the year after midterm, which is 2027. So if we can take advantage of 2026 to build up for 2027, this is the highest return we can have. And then the year into elections next time is probably the weakest for a second term president because he doesn't care about it there. Okay. Same thing there. Midterms tend to be. Now, this is going to be very, very important. I'm going to teach you a little trick here that I haven't taught anybody before. These average numbers, this is how you apply game theory. All right. So the average drop in a midterm year is 17.5%. The average increase is 31.5%. So what you do going into the year, you set up your buy, your call, purchase whenever it drops 17.5%. Let me show you what that means. If you do a normal one, this is this year as an example, the average year. So if I took this example, 12.9, all right, this year, so I'm going to skip to it. Buy at the average drop. This is 12.7. This year was the first election year, 2025. If I had bought a call or just bought the stock at 12.5% roughly did, and that was on 3rd of April. It dropped further, but that's when I bought it. By the end of the year, that purchase had gone up by 24.7%. So the secret in game theory is understand the odds. Whenever you get that, have your purchases or calls put in place beforehand. And even if it drops further, okay, remember this had an 11% increase. So minus 12 plus 11, all right, is roughly 23 and a half. Well, we got here, the recovery from that point was 24%. Pretty well right on average. So this is the edge that a good investment manager will have. They will understand game theory, understand probability. So for next year, our marker is 17.5. All right. We don't know when it's going to happen. But if it happens, we immediately put a call out towards the end of the year. So that allows you to buy 100 stocks of, let's say, S&P Y. And if it increases by 17 plus 31, all right, which is roughly 40, 48, think of what happens to the call price when you have a 48% increase. That's over 100% increase. But even the S&P Y index, if you bought that, and that's how you take it on. We just don't know when. So I would strongly apply the same theory using game theory. And this is something people can't do. All right. From the average drop, you're up 37%. So again, this matters. We do expect to drop somewhere in the year. We're saying it somewhere around April-ish. Okay. Again, midterms. Again, I'm just going through the same thing here. Why does midterm? Because the retail client is less there. Now I want to show you this whole site. This was given to me by a friend on website. I thought it was pretty cool. How do you get to $1 billion? So let's say I'm going to pick a number. If you did $250 a month, this is just using the market, and at 6% growth, it would take you 52 years. Now, if I did the $250 a month, and I did, let's say 10% or, 11% return is 34%. So now you understand why returns matter. But let's go to $2,000 a month. If I started at $2,000 a month, at 6% return, I would get $1 million in 21 years. Okay. Back at the bottom here, 21 years. Sorry. But if I had 1% extra, I got 20. If I done 11% there. Now, why is these percentages important? So now I'm going to take you to the other side of the equation. What is the average return of the stock market over a 20-year period? So you can see in 2025, the average 20-year period was 10.9%. So 20 years. So if I had gone 20 years ago, put $2,000 a month in by the end of 20 years, so 2005 to 2020, I would have had $1 million. So this is why we tell people to dollar cost average in, and then we are concerned about return. We're not concerned about volatility. We take advantage of volatility. When everybody tells me, oh, the market's dropped, I'm probably the happiest guy around. When everybody's complaining, well, the market dropped last year, you will not realize how happy I was because we had a process. And that just accelerates it. So if you look around here, 6%, 2019, the 20 years before that, 6. Well, if you had done that at 6%, it would have been 21 years. You would have still become that. So again, knowing this financial planning, dollar cost averaging makes a big deal of importance. And why? Because there is more green than there is red. Markets tend to be positive more than they are negative. Pessimists, they sound smart, but it's optimists that make money. Zoom out, far more green. Here, I'm just going to go through the green here. And I want to show this one here. The most common return in the stock market is actually 5 to 15%. Okay, more positives. So we're not over yet. We're still in the beginning phase of it. History repeats, but each time it repeats at a higher point. We've seen that. Pessimists, don't be that. Stay calm. We believe the good in the world. And for that, we have to be the good in the world. And that's what I've been pushing out on my trip to the Middle East, is where is the good? And I'm telling you, they're doing some fantastic good things. We've broken ground with them on so many things. There's an interesting, we're doing something that no other Canadian company, even US company, has really done over there. And that's get them to be excited. They're very skeptical about things. But all of a sudden, we're beginning to see interest in our way of thinking, which is concentrated game theory, evidence-based, all right, and probabilities. David, thank you very much.
Great job, Rana. Great job. I think this was, given what happened over November, really important lessons here and understanding what happened, because as we know, fear can make you question things and question what you're doing, but it's the lack of understanding. I think you did a great job bringing that understanding. So you started off using a couple examples, but history is a good guide to the future. And I think then your presentation flowed from there really nicely. You looked at AI, this whole overvaluation of AI, great example showing what happened in 2000. Cisco was the kind of the darling of the internet, right? That was the star stock. And as your chart showed, stock price went parabolic, earnings didn't follow. And then you look at NVIDIA today, it's the star, and its stock price and earnings are going up in tandem.
Wow.
Much different situation.
The Genesis machine is going to make it's an accelerant. It's an exponential growth.
And that,
which isn't priced into PE yet.
Yeah, you mentioned that at the end, and I think that one a lot of people are missing because of the demand that is going to drive. That is huge. And then you showed us examples again, how bad the media can be, talking about the internet. Newsweek saying the internet's going to fail in 95. In 2000 and 2001, we had, a passing fad, or New York Times, the internet is over. And even in 2020, people questioning online is not the future. So the media is not your friend, and they give bad advice. When we looked at our indicators, these are important. Fear and greed. The fear on November 18th was a 9. That's extreme fear. It's still an 18.
Yeah.
And for us, that's a positive in terms of the investing environment. So that's good. The railroad tracks, the drop that we had didn't cross the 125-day moving average, this one we experienced in November. Breadth is slightly going up. And then when you look at your McClellan oscillator for breadth, if you go from a minus 60 to a positive 35, which we've done, historically 9 months and 12 months later, the market is up. So these are all good indicators, and it's a good clue for December, right, to start. Put call ratio, this is huge, and you got into this even more, but the puts have now spiked a little bit more, which is good. So speculation has been taken out. There's not as many calls. That's a positive. And then same thing with VIX. You had a November 26th spike, and now we're below the 50-day moving average on VIX. So that's sharply come down. And really the whole thing behind this that you got into was the call volume was a record, actually, a record high, highest on record by November 19th. And then you walked us through the Thursday right before OPEX and the carnage that took place, which was basically the market makers wiping out all of that 3.1 trillion in notional value, which they weren't going to have, allowed to have. And this is something because, like, as I mentioned at the time when you were going through this, November's usually not a month for nasty OPEX, but your chart just showed how many months in a row there wasn't really any significant OPEX pullbacks, and the call volumes, just people got more and more greedy. Call volumes then hit a record. It was bound to happen, and this is when it happened. And now look where we are. We're back to I think the highs of the 20th already. We've recovered all of those losses, or most of them. And things have settled down, right? The put call, the VIX.
Now there's no mention of NVIDIA's overvalue. Right. All of a sudden, media's quiet on it.
Yeah, the headlines all disappeared. They meant nothing. But I think this is really important because there's a lot of that talk going on. And really it came down to this one thing. And look where we are now. So I think that was a very important lesson. And it's something that we really, really keep an eye on, which is that put call and looking out for this. So then you looked at some of the bad news out there. You looked at what AI could possibly mean for job losses in various areas of the workforce. You're seeing some corporate layoffs happening. You're even seeing AI, cause potential job losses, and they have for some of the biggest real estate companies in the world.
It's going to get worse. right? Be prepared.
Be prepared.
Right? Be prepared.
Yeah. Manufacturing could also be affected. Unemployment in Canada, really bad for the 15 to 24-year-olds, but not great across the board in Canada. U.S. college graduate unemployment is rising quite a bit.
25%. 25%.
So what is this? What is the correlation between that and AI? There could be an overlap there, right? Where some of these jobs aren't needed in those spaces. Some people say, and a lot of people are promoting the idea, if you work with your hands, you probably are more.
In China, they have a robot that does plumbing for you.
Right.
It has a vision. It has a vision camera built in that looks for your problem, and it actually solders and fixes the pipes.
Interesting.
So I can't even argue that a plumber is safe now.
Maybe, right. Maybe not.
I just saw it and I go, wow, this is crazy. But it's not in general use. They got a long way to go yet on it.
Yeah. You look at the Toronto real estate, that's not good in any respect. We've talked about this in the past, but again, the demographics in China are terrible.
Yeah. On the Toronto real estate,
sure.
I'm strongly encouraging, if you've got any real estate friends, to talk to us. All right. And build a program that isn't just dependent on your real estate commissions.
Right.
All right. Build that in. Most financial planning firms, most investment firms don't think this way. We're doing precision medicine on a sector that I know is going to affect a lot of people because they're all living on the hype of, well, interest rates are going to drop, volume is going to increase. The problem is job losses are too high. So interest rate drops. You need jobs increasing with interest rate drops to get that market moving up. So please contact us.
Yeah, we can provide income streams, right? To help. Right. Absolutely.
Growth and income.
Yes. You have the demographics bad in China, and they've taken on more debt than any other country since 2008. So they're
the growth.
Yeah. You looked at the drop in Bitcoin and the outflows of the ETFs of Bitcoin, how that's affecting companies like Strategy. And then BlackRock has 100% private loan loss. So is this the cockroach theory potentially in private equity, which has been very popular for the last few years? So watching that. But there's good news. And you touched about kind of looked at what happens when we do have a negative November. And the last 10 times we've had that, the market's been up in December. So that's interesting to look at. There's not 100, nothing's guaranteed.
We're not predicting it.
We're not predicting
this is what history said.
But it's a good indicator. Earnings growth expectations continue to go up. They're strong. Earnings are really what drives the market. And if earnings are, that's a positive. You're seeing lots of buybacks now taking place. That's positive for the market, supporting prices. And then you looked at volatility, and this was really good because, as you pointed out, we get volatility every year. And you looked at a couple of the last 2 years, 23 and 24, which were great plus 20% return years, mid 20% return years. And yet there were 1 to 2 double-digit pullbacks each year. I remember last year, the second one, you said we had a first half one. The second half one was right around the August long weekend. It was nasty. And that was the second one of the year. So you got to be prepared for these things, even when you have a really good return for that particular calendar year. So it's taking advantage of that, of those, knowing that's going to happen and take advantage of that. The other thing that I thought was very interesting was you looked at concentration. So many people talk about, the market's, the S&P 500 is too much concentration at the top. This isn't healthy.
It's actually your friend.
It's actually your friend. Your data went back to the 1960s. Yeah. And showing that when you have greater concentration, the market tends to go up. And when you start losing that concentration, you have periods where the market doesn't do as well. It can go down. So you want concentration. It's actually a sign for good returns in the market. And it actually makes sense if you think about it, because if your best companies, which are by definition going to have the most concentration, if they start losing that, that means they're bringing the market down.
Exactly.
Right. The small companies don't have enough weight in the index to really give you positive return. So it's not a good sign to have, so that was very interesting because the narrative is the complete opposite that, but the facts don't back that narrative up. We looked at Canada and the US because this has been a good year for Canada. And as you pointed out, Canada is driven by financials, by energy, by materials. And those have been good this year for the most part. And the market in Canada has done better than the US. But if you look at the history, you don't have that sustainability where Canada year after year can outperform. In fact, it's the opposite. You get multiple years in a row after the Canadian markets outperform the US, where the US outperforms Canada. So you can't look at your recency bias and just say, oh, it's going to be in Canada next year. You can't do that. So be mindful of that. You looked at oil prices, they've fallen. Supplies increased, drill, baby, drill. But when you adjust it for money supply, and your data went back decades.
This is crazy. Very good observation. Good that you got this point.
It's at a historic low. There's only about 2, maybe 3. This may be the 4th point in that multi-decades where it's hit this level. And that's your
dividends.
Yeah. So looking at energy companies that pay dividends, this could be a good contrarian play. We, I know, here at our firm are looking at that for 2026. More good news. The U.S. GDP is very strong. That's good. There's no central banks hiking rates anywhere across the world. You looked at AI companies, and again, their profit. What stood out? They have better profit margins.
Okay.
Plain and simple. And then you looked at monopolies like Google and search and semi-fabrication and TSMC lithography with ASML. But the duopolies.
Yeah, even the duopolies are good.
We live in more of a duopolistic world, right? Where you have a couple of players that dominate these spaces.
Pepsi, Coke. There you go, Pepsi and Coke.
There you go. That's a good one. Pepsi, Coke. And you're finding that, in your examples, Siemens was the only non-U.S. company.
Yep.
But very interesting because, and that comes back down to a lot of things we do. We're concentrated investors, and we look for the best companies in their field. Number one, sometimes number one and number two. Well, it goes along with what we're seeing out there in industry. Amazon, $50 billion spending on AI for the U.S. government.
Yep.
Now, you also then, right after that, introduced the Genesis mission. Do you think that's a coincidence that Amazon is spending $50 billion for the U.S. government? I don't think so. He's
one of the smartest presidents I've ever seen.
Then you also talked about data center power, but and that Genesis platform was very large, very robust in terms of what it's encompassing. $80 billion U.S. government into the nuclear. Right. Could that be tied in with the Genesis? Right.
Percentages.
Right. Because you have to have the power to drive all this. So this is a huge, I think, really, like you said, Rana, this is really fallen under the radar because this is obviously
we're the only ones talking about it. That's what gets me. That's only we're trying to say which other PM or portfolio manager is turning. Nobody is.
This whole question about, AI demand, is it over? Is there demand? Is it over? The government is going on a multi-year, multi-billions of dollar investment. And who are they going to use? Amazon, NVIDIA. You can name all the companies. This is this has probably got to be the biggest investment the U.S. government, like a program. I think since the space program?
Biggest investment since the moon, the mission to go to the moon.
Yeah, exactly. It's massive, and it's not a one-time thing. So you got to look, I guess your point, you got to look big picture here. Forget the stupid headlines. You got to see what's actually happening on the ground. And the U.S. government has been working with the tech giant companies to do this, and they're more than happy to oblige. And so this is really important. I think this is huge. Yep. Then you looked also you talked about Scott Bessent, the Treasury Secretary, optimistic for 2026, non-inflationary growth. I think there's probably a lot to that. Not only the Genesis project, but you had a lot of the things in the big, beautiful bill. You had accelerated depreciation costs. You've got a lot of investment coming into the U.S. So I guess our thing is, because you looked at that, and then we look at the midterms, we're going to have probably a very good, strong.
The words he used was, "We've set the table." Now think about going to dinner and he's saying, "I've set the table."
Yes.
All right. Yeah. There's a lot of importance in those words. He used those words very carefully.
Yes, and he does speak very carefully. I've noticed that. Very carefully. Yeah. You looked at volatility spreads. I think this is important. Very tight when you look at December historically, and when you look at a March, there's much wider chances of volatility, the spread of it. And I'm going to get to the midterms. This is what stood out to me. It's the average drop and the average increase. So over that 4-year cycle, the largest average drop is in a midterm year, and the highest average increase is in a midterm year. So it had the best. So as you said, knowing that if 17.5% is our kind of our bogey target here, that can be if we hit that can be a sign to start investing. I know that's what we're going to be doing at the firm. We're going to be watching for these opportunities, and then you have a really good chance of, now when the market turns, to really get that increase, right? And we know or suspect, I guess, Rana, we're probably going to get more than one pullback during the year. We normally do, even in a good year.
Yeah, we got a plan for it. I just told you what the average was and everything.
That's right.
Good put your program into place.
Yeah, and then the last part also, which is from the election, our November to April is usually good, historically good. But November to April after a midterm is even better, right?
After midterm.
After a midterm, that November to April. Yeah. So
into 2027.
That's right. So using these pullbacks and when they take place, we can be strategic around how we deploy capital.
Year. It's going to be a good year for us.
Yes. Yes.
I don't know about others, but I can tell you we've got the plans already.
Yeah. And I think the most important thing, especially for our investors, is to have a sense of what is likely to happen. And what I mean by that is we don't know details, but in terms of be prepared for pullbacks.
70-30, we know we're going to be wrong 30% of the time.
Right. We don't have perfect timing, but chances are we're going to see some pullbacks, some decent sized pullbacks. Be prepared for them. Don't be surprised by them, really. That's, I think, the key is your mindset, knowing it's going to happen. Yep. And then finally, I think that what was cool was your how to earn $1 million based on how long it takes, how much money you're putting in a month.
What's the root?
Yeah. And I thought that was really interesting to get that. So those are my notes.
Right.
Great presentation.